Hello guys, welcome to the second episode of the Conclub Brief. In this segment, we will look at the biggest industry across the globe, that is the oil and gas business. There are three major dimensions of oil and gas business: upstream, midstream, and downstream. Upstream is all about exploration and production of natural gas and crude oil. It can be either onshore or offshore. Upstream is a high risk, high return game because there is always a probability that you might explore in the wrong location and never find a profitable reserve. It is a highly regulated segment across the globe, and the impact of politics on the crude oil prices is something that we see very often. And finally, it's a very technology intensive business. With oil becoming more and more rare, the role of technology in getting every single last drop of oil is becoming more and more important. Crude oil is a mixture of different components. The mixture as it is not very efficiently usable for deriving energy. The midstream separates its crude oil into different components and mixes them in various proportions to give us final products like petrol, diesel, kerosene, LPG, and ATF. Midstream is a low-risk business and it's moderately regulated across the globe, but it is heavily dependent on both upstream as well as downstream. Any supply side or demand side fluctuation can have very severe implications on the profitability of midstream business. Downstream is all about marketing the products that are produced by midstream segment. It is basically a margin business. India specifically for a very long period of time has seen some very stringent price regulations. Aviation turbine fuel was the first product that was deregulated in 2002. Petrol was deregulated in 2010 and finally diesel was deregulated in 2014. But even after the deregulation, government still plays a major role in pricing of these products in the market by using the handle of excise duty. And this is the reason when crude oil prices fell by more than 50% in the global market, we only saw a 13% decrease in the price of petrol in domestic market. LPG and kerosene are still the two products which are regulated by government in terms of its pricing. With some serious competition coming from private players like Reliance and SR, the state-owned oil companies like BPCL, HPCL, and IOCL are under some serious pressure to improve their operational efficiency and marketing reach. Let us look at the upstream business in a little bit more detail. The two main components of upstream business are exploration and production. Historically, we have seen that typical time gap between a successful discovery of oil reserve and a full-fledged production is about 20 to 30 years. Most of the major oil fields in operation today were discovered in late 70s and early 80s. Exploration normally begins with search of oil with some very sophisticated geological and geophysical surveys. But still, there's a very high probability that you might not find oil in the reserve that you are exploring, and hence the first well is often called a wildcat well. After you have verified the size and profitability of the reserve, the next step is drilling. Drilling is extremely complex and costly. There are many variations of drilling. Some of the common ones are vertical, horizontal, S-shaped, and J-shaped. After the well is drilled, the reserve will start producing oil and gas under its own pressure. But as the reserve gets older and older, we have to look at some very sophisticated enhanced oil recovery methods to maximize the production of oil and gas from the reserve in operation. The next step is trading and transportation of oil and gas that is recovered from the reservoir. Shale gas is a term that we hear very often these days. So let's understand what is the difference between a conventional oil field and a shale gas field. In a conventional oil field, the rock structure is porous. Hence, if you drill a single vertical well, you can recover the maximum amount of oil and gas that exists inside the reservoir. But on the other hand, a shale gas field, the rock structure or the shale structure is non-porous, and hence drilling a single vertical well would not result in effective production of gas. Hence what we need to do is drill horizontally and do fracking. The technological challenges involved with horizontal drilling and fracking make shale gas field exploration extremely cost intensive, and it is only feasible when the price of conventional oil is higher than a certain break-even point. Typical break-even price is between $60 to $80 per barrel depending upon the type of reserve that is being explored. Consistently high prices of conventional crude oil throughout the early 2000s encouraged heavy investment in shale technology in US. Many such fields are active today and have contributed heavily to the surplus of oil in the global market. The global oil production is about 100 million barrels per day. To this production, OPEC contributes to about 43%, US contributes to about 12%, and Russia contributes to about 13%. India's contribution to global oil production is only about 1%. In terms of consumption, US consumes about one-fifth of the entire oil that is produced in the world, China consumes about 12%, and India consumes only about 4 to 5% of the entire production. In terms of gas, the total global production is 3,500 billion cubic meter. US is both the largest producer and consumer of natural gas. India is at a very nascent stage in terms of utilization of natural gas for fulfillment of its energy requirements, and annually it contributes to about 40 to 50 billion cubic meters of gas both in terms of production and consumption. The major gas fields in India are in KG Basin, where it is being explored by Reliance, but the production is continuously decreasing. Major oil fields are Mumbai High, Digboi in Assam, and Ankleshwar in Gujarat. In order to connect the upstream and the downstream, midstream plays a very important role. One of the most important aspects of midstream business is transportation. In increasing order of cost, transportation can be done through either pipeline, ships, rails, or road transportation. The next step is refining. The crude oil that is received from upstream is separated into different components and processed, and these components are then mixed back in different proportion to give final products like petrol, diesel, ATF, kerosene, etc. A typical barrel of oil will give about 35 to 40% as gasoline, 20 to 30% as diesel, 5 to 10% as kerosene, and about 5% as LPG. Government of India is pushing for maximizing the utilization of natural gas for fulfillment of our energy requirements. But because we do not have enough natural gas in India, we have to import it from outside. Being a gas, it is very difficult to transport it without converting it into a liquid form. And hence, having regasification infrastructure is very critical for promoting the usage of natural gas in India. India is a net importer of crude but a net exporter of petroleum products. The total refining capacity that we have today is about 230 million metric tons per annum, whereas the domestic demand is only about 190 mmtpa. Hence, we export about 40 mmtpa of petroleum products. The refining capacity is dominated majorly by IOCL, which holds about 30%, and Reliance, which holds 26%. The entry of private players has accelerated growth of refining sector in India. Reliance Jamnagar is one of the largest and most complex refineries in the world. The oil marketing in India is majorly dominated by the state-owned companies BPCL, IOCL and HPCL. Combined, they sell about 97% of the total products that are consumed in the Indian market. Natural gas as a fuel is only common in major cities in India, and each city has a different joint venture taking care of the marketing aspect. For example, in Delhi we have Indraprasth Gas Limited, whereas in Mumbai we have Mahanagar Gas Limited. Now let us look at some important revenue and cost streams for oil and gas business across its different segments. For an upstream business, the major revenue stream is from sale of crude oil and natural gas. Being a very technology and capital intensive industry, capex in exploration and production and research and development costs are the major fixed cost for the upstream business. Utilities such as energy and water that are required during production, maintenance and spares, and transportation are the major variable costs for an upstream business. The midstream generates majority of its revenue by selling products to the oil marketing companies. The major fixed cost streams for a midstream business are equipment and capacity capex, land and other assets. Crude oil prices, utility prices, maintenance and spares, and operational losses contribute to the major variable cost streams for a midstream business. A downstream business recovers majority of its revenue from sale of petrol, diesel, CNG and other products to the end users. It also sells some blended products which are highly profitable like lube oils. We often see some other customer-centric services being provided at this point of sale such as shopping stores, servicing facility and cleaning facilities. The major fixed cost stream for a downstream business is land and equipment cost and pipeline and other infrastructure.
Significant variable costs are product costs, distribution and storage charges, maintenance and utility costs.
In order to understand where the oil and gas business is heading towards in future, it is very important that we understand what are the major opportunities, challenges, and growth drivers. Unconventional gas resources is going to be the major growth driver into the future. Technological developments will play a vital role in extending the life of existing reservoirs, and stress on offshore exploration will hopefully result into major discoveries of oil fields. The biggest challenge in front of the industry today is end of cheap oil. Extracting oil from the existing reservoirs is becoming more and more costly as the reservoirs are depleting. Degrading quality of oil is the second biggest concern. The oil that we get today is becoming more and more heavy, hence we can recover lesser amount of petrol and diesel from it, which are the most useful products. Having a very high carbon footprint, oil and gas business has very heavy impact on environment. In that view, many governments are coming up with very stringent quality regulations. In order to meet this quality regulation, midstream business has to do very heavy investment in its infrastructure. Being a hazardous industry, safety is a paramount challenge for the oil and gas business always. The biggest opportunity in front of the business is shale gas and gas hydrates. Enhanced oil recovery methods are important in order to maximize the production from existing reservoirs and extending the tail of cheap oil. The transportation methods are now shifting from road and rail based to pipeline transportation. Pipeline transportation is much more cost effective than the other two methods. With Government of India stressing the utilization of natural gas in Indian cities, the importance of CNG is going to improve. And in that view, infrastructure such as regasification terminals are going to be the future of Indian oil and gas business. Let us look at some important terms that you must have heard about but might not be sure about what they mean. A barrel of oil is equivalent to 159 liters. Brent and WTI are nothing but names of the crude. The reason you hear them so often is because crude prices are benchmarked on the basis of these two. Brent is commonly found in North British Sea, whereas WTI, which stands for West Texas Intermediate, is found in US. Euro and Bharat fuel stages are indication of fuel quality regulation. The most common regulation is on amount of sulfur. Every progressive fuel stage is more stringent. Currently in India, metro cities use Euro 4 grade fuels which allow a maximum 50 ppm sulfur in diesel, whereas the rest of India uses Euro 3 grade fuels which allow maximum 300 ppm sulfur in diesel. Cost component of petrol is something that everybody is very curious about. In October 2016, at about 65 rupees per litre in Delhi, the major components of petrol cost structure would be crude cost 8 rupees, refining cost 13 rupees, excise duty 22 rupees, state VAT 14 rupees, OMC margin 6 rupees, and distributor margin about 2 rupees. We can clearly see excise duty plays a very significant part of the entire cost structuring, and this is the handle that central government uses in order to manipulate prices of petrol and diesel in the domestic market. So, why did the oil prices fell and why are they recovering now? After the 2008 global financial crisis, the oil prices steadied to about $100 per barrel and was significantly constant till about 2014. Around 2014, there was a significant mismatch between the supply of oil and demand of oil in the global market. The supply increased on account of increased shale gas production in US and improved geopolitical situation in the Gulf countries, whereas the demand decreased on account of slowing growth in countries like China and Europe, and hence there was a mismatch between supply and demand. The OPEC countries, in order to maintain its market share, did not cut down the production of crude oil from its production sites, and hence the price of the oil fell in the global market and it came down to as low as about $25 per barrel. Now, as the demand is picking up across the globe and there is some amount of control being exercised by the OPEC country over the production, we are seeing that the oil prices have improved to about $52 per barrel
and it is expected that they would remain in this range for about few years into the future.